So now we will start with options chapter, new chapter, that is options. Chapter number 6 is options. Chapter 6 in our material. Okay. See, I will introduce you, before introducing you to the options chapter. Okay. What I will do is, I will give you an overview of what is happening in derivative segment, what we are discussing in derivative segment. See here. Generally, 3 derivatives are discussed in your syllabus. Are you listening? Are you all awake? Okay.
Yes.
Are you sleeping? Are you all awake?
No.
Fresh chapter we are going to study. Forget about futures. Now we are into fresh topic. Okay, options which has no connection with futures as such. Okay, we will go from basics. No issues. Okay, only one thing: continuous compounding calculation alone will be required. That too in later part, option valuation. Okay, now just listen. I will explain from basics. I will give you an overview of the entire derivative segment in AFM syllabus. See here. In our syllabus, there are broadly three types of derivatives discussed. Okay, it's futures, okay. Three types of derivative instruments are discussed in our syllabus. The entire AFM syllabus, you will come across three instruments, which mean derivatives are nothing but a financial instrument. I told you. Okay, three types of derivative financial instruments are discussed in your syllabus. One is futures, there is options, then there is swaps. Understood? Here, for futures, you have, okay, derivatives instruments. What are derivatives? I told you. Derivative instruments are those instruments which derive its value from the underlying asset. Correct? Based on the underlying asset, the derivative instrument will also keep on changing. Which means if your the underlying asset is equity shares, correct? Underlying asset may be different. For example, sometimes the underlying asset may be equity shares. Equity shares is also an asset, correct? Currencies are there, dollar, yen, okay, euro, pounds, all these currencies are there, okay. So these currencies are also underlying asset. Commodities are there, okay, wheat, rice, I told you, steel, gold, all these commodities which are traded in the market. So commodities are also there. They are also asset, correct? So based on commodities, the futures or options which you are making, the instrument which are available, these are called as commodity derivatives, correct? Then there are underlying asset. There are different types of underlying asset. I'm trying to explain. There are different types of underlying asset. It might be equity shares. It might be bond. Okay. It might be currencies like yen, dollar, euro, all these things, or interest rates. I told you na, interest rate risk management. A separate chapter will be there, wherein you will see interest rate itself is a asset, which means the RBI they will fix interest rate na 8.5%, 6%. They will keep on changing the monetary policy. Okay, so interest rate is also an asset. Based on interest rate, if you put some derivative, that is called as interest rate derivatives, interest rate futures, interest rate options. Like this, based on interest rate, there are these things. Understood? So there are various instruments. First of all, the futures, okay, there are equity futures. Equity futures. Equity futures derives its value from equity shares. Underlying in equity futures order, underlying asset is what is underlying asset? Equity shares. Then there is, okay, commodity futures. Commodity futures. Correct? Then there is interest rate futures. Then there is bond futures. Understood? Okay, like that is goes on. Currency futures. Okay, these many futures, subcategory, these many futures are there to be discussed. These many futures are there in your syllabus. Come to options. What are the options available? Equity options. Okay, underlying equity options, the underlying asset is what? Equity shares. I will explain everything in detail, don't worry. Okay, I am just giving you an overview of all the derivative instruments here first. Okay, then commodity options. Commodity options. Then there is interest rate options. Okay, bond options. Now, currency options. Bond options are also there. Yes, okay, we already discussed bond markets with this one. Not much. Inga swaps, currency swaps, interest rate swaps. There's nothing called as equity swaps. Okay, there's interest rate swaps, currency swaps. Okay, these things are available. Now, see, we started with futures chapter, correct? The last chapter we discussed futures. That is only equity futures. This is called as pure futures. Equity futures. Now we are going to discuss equity options. In this chapter, what we are going to discuss? Pure options, equity options. Okay, where underlying asset is equity share. Okay, this is what we are going to discuss. Incidentally, we also discussed commodity futures. Correct? We also discussed commodity futures. Bond futures, bond market, we discussed. We discussed in the sense it is not specifically discussed in our syllabus, which ideally should be included in the bond market itself, bond chapter itself, security valuation chapter itself. No issues. Come to other areas. Interest rate futures are there. Correct? So, interest rate futures, interest rate options, and interest rate swaps. Okay, these three are given under interest rate risk management chapter. Interest rate risk management chapter. Got it? Okay, you can see in the material there is a separate chapter called as interest rate risk management, where these three instruments are discussed. Correct? Up interest rate future we discussed there. Okay, again the interest rate option is discussed there. Interest rate swaps is discussed there. Over. Now come to other areas. Currency futures, currency options, okay, and currency swaps. These things are discussed under forex chapter. Okay, currency futures, currency options, and currency swaps. These three things are discussed under, these two are discussed under this chapter. Okay, what is that? Forex chapter. Forex chapter, which we are going to discuss next. Okay, forex chapter we have not yet studied, which we will discuss there. And in one or two, if you see interest rate swaps and this swaps, currency swaps, separately there is a chapter called as swaps, where we will discuss. We have a separate chapter. Okay, in the institute module you will find interest rate swaps questions, interest rate future option in interest rate risk management, currency future option swaps in forex chapter. Have you all understood this overview? So now what we are studying, I am trying to make you understand. We are only discussing equity options. We just now studied commodity futures and equity futures are mainly correct. Like that, in the options chapter, we are only going to discuss equity options. Correct? What we do? See, options, futures and option. These are collectively called as what? F&O. I told na. These are, I showed you the market also na. Derivative segment. F&O segment is available wherein futures and options will be there. Swaps will not come under this because it is traded over the counter. Don't worry about that. Okay, that is not exchange traded. Over the counter exchange traded. I will discuss later. Don't worry. Now what I wanted to communicate is this futures and options are collectively called as F&O derivatives. Correct? Either the options are of, now we are discussing options are there are two types of options, call option and put option. Okay, I will detailedly discuss. I have separate slide for discussing. Don't worry. There are two options available. One is call option, then there is put option. Okay. Now, just for either one illustration, okay, spot price of Reliance, spot price, share price of Reliance today, assume 2000 rupees. Can you just assume this? This I will discuss. Okay, when I discuss, I will explain. Okay, today assume that the share price of the Reliance is 2000 rupees. This you can assume till now. Now we will go on to specific discussion in this regard. See, we'll start with first we will take call option for discussion. Okay. Can you see the PowerPoint slide?
Yes, sir.
Okay. See, call option. Okay. There are two parties, A and B. Okay. Two parties entering into contract. Okay. Option. What is option? Option is a contract which gives one party right to buy the underlying shares, okay, on a given date at a given exercise price, strike price. Understood? I will explain this and I will tell again the definition and will make you understand. Okay, first carefully observe the illustration alone. Rest everything will be clear. See, two parties are there, A and B. Correct? They are entering into a contract. Okay, they are entering into contract wherein A gets right to buy shares of X Limited. In Reliance Limited, you assume. That's why I showed you. Okay. Reliance share price is how much? For illustration purpose, assume it to be 2000 rupees. Got it? So there are two parties. Okay. A and B, wherein A purchases the call option. Which, okay. What is call? He gets a right to buy the shares of X Limited. Underlying asset is X Limited. Based on the underlying asset, option contract is created. Just like futures, where underlying asset based on futures contract was created, here option contract is created. In the option contract, only thing is A is getting right. Futures contract, both the parties were having obligation to fulfill the contract. Here it is not like that. That is why name itself suggests it is an option. Option available to whom? For A. Okay, see here. A is having right to buy the shares of X Limited, for which after 3 months, maturity period is 3 months, which means, tell me children, today he wants to buy the shares or tomorrow he wants to buy the shares? Tomorrow he wants to buy the shares. But for that, he wants to agree, okay, the price today itself. He want to lock in the price today itself. For example, assume today's Reliance share price 2000 rupees. I told you na. Okay, he doesn't have money to buy. Na, assume he doesn't have required cash to buy the asset. But after 3 months, he is fearful that the price might go up and he will require more cash to buy the share. Correct or not? See, today is 2000 rupees. Reliance is trading at 2000. He feels that it might go to 2500 and the price might jump to 2500. So he may miss out and cannot buy the shares. Okay, that's why what he is trying to do is entering into a contract, okay, to make sure that the buying price is 2000. Understood? See, he gets the right to buy the shares of X Limited after 3 months at 100 rupees. See, 2000, just for example, Reliance shares, all those I told. Here, assume it to be 100. Okay. This example will separately take. Okay. Then I will link it with Reliance Limited. Got it? Just assume X Limited shares you are going to buy today or tomorrow. Tomorrow. But I am fearful of price increase. That's why I am entering into a contract. What you are getting? A is getting the right to buy the shares of X Limited after 3 months at 100 rupees. This 100 rupees is called as exercise price, the agreed upon price, the price at which the share he will have right to buy the shares. At what price? 100. This is called as strike price or exercise price. Are you understanding till now? See here. And what is the 3 months called as? This is called as maturity period. I have told you in derivative segment, if you see, okay, this is term of the option. Okay, see the derivative segment, if you notice, on any given date there are 3 contracts available, three contracts, different maturity date. Understood? 1 month futures contract or 1 month option contract, 2 month option contract and 3 month option contract. Correct? This is called as maturity period. Okay, here in the futures what will happen, anyway in between also you can sell out and come. Correct? Here also you can sell out and come, that is different. But here generally on the date of maturity only the you will close your position. That you understand. See here. So what is happening? There are 2 parties, A and B, wherein A is buyer of the call option. He is buying the option. The buyer of the call option gets right to buy the shares. Okay. At what price? At agreed upon price of rupees 100. This 100 is called as exercise price, and the 3 months period, okay, after 3 months that is called as maturity period of the option. This is clear? So A is called as holder of the option or buyer of the option. Okay, the person who wants the right, who wants to enjoy the right to buy the shares at a later point of time is called as holder or buyer of the option. Holder na enna, buyer na enna, same person. A is the buyer or holder of the option. This is clear? B is the person who is giving the right, who is selling the right. Understood? See here, A is buying the right, B is selling the right. To whom? To A, which means B is telling you take this instrument, which means I am giving a right to you to buy whatever might be the price on the end of, at the end of 3 months. Okay, I will sell you these shares. I will give you right to buy na. He has obligation to sell. See, B has obligation to sell the shares, which means, see, tomorrow the 100 rupees is strike price na. Tomorrow the share price might even jump to 200. You don't worry. I will insure you the risk of price increase, and I will sell you the share for 100 rupees, whatever might be the share price in the spot market. It might be 200. You don't bother. You don't worry. I will sell you the share for 100. This is what B tells to A. Purunjada, what is the contract? A enjoys the right to buy the shares and B sells the right to A. Understood? I will explain. So B is called as seller of the option or writer of the option. What is the difference between these two? Okay, A is called as holder of the option, B is called as seller of the option or writer of the option who sells the contract to A. Understood? Now see, B is selling this benefit. There is a benefit for A. What is the benefit for A? He has the right to buy the shares at a lower price even when the share is trading at high price in the spot market after 3 months. Correct? In that case, okay, the writer is giving some benefit for you. Writer will charge you some premium. Correct? So holder of the option will pay some premium to the seller of the option or writer of the option and enter into this contract. So what is the income for B? It is premium. What is the benefit for A? If at all share price increases, the difference will be the difference between the share price on the maturity date and the the exercise price or strike price is the benefit enjoyed by A. Understood? Now I will try to explain this in such a way that you will understand it. I will try to equate it with insurance contract. The option contract is nothing but like a insurance contract Wherein what happens in insurance contract, have you all seen okay, bike insurance, car insurance, all these insurance contract will be there and what is happening in insurance? See, insurer, there are two parties. One is insured, other is insurer, correct? We are taking life insurance or health insurance or general insurance, car insurance, motor insurance, all these things are there the insurance company will be there ICICI Lombard, okay, ICICI Production, all these companies are insurers. You call them as insurers. What they do, they insure, okay, and they undertake your risk, which means in adverse scenario, okay, in suppose your any accident happens to your car, okay, if your car is damaged, if your bike is damaged, you can make a claim and they will reimburse the amount, correct? So what they are ideally doing, they are undertaking the risk, understood, and they will charge some premium. That is how insurance company operates, correct? This is called as writing of insurance. Have you seen the annual report of insurance companies? If you see, they will say this year we have returned this much amount of risk. So writing of risk. That's why underwriting of shares. Have you seen underwriting chapter? Underwriting, who are underwriters? They, before IPO, okay, the lead brokers, merchant brokers will underwrite the shares in case in IPO the shares are getting undersubscribed. The balance portion they will buy, which means they are undertaking the risk. Okay, here B is writing the risk, which means he is providing insurance, which means don't worry, even in adverse scenario, in case your share price, okay, today is 100 rupees, you are fearful that share price might jump to 200 or 300, don't worry, we will insure you, we will assure you and make sure that you have a right to buy the same share for 100 rupees strike price, correct? Just like your options, okay, have you all seen stock options, employee stock options, wherein the employer will give option to buy the shares of the company with the lower exercise price, which means whatever might be the share price in the market, they will give you right to buy the shares at a lower price. Understood this? This clear up? Entire structure of the options is clear. Call option, right? So what is happening? So there are two, to summarize this, are you all able to understand? I will summarize it once again. Please carefully listen. There are two parties. Who are they? A and B. Who is A? A is option buyer or option seller? Option buyer. Okay, what the buyer gets? Okay, he gets the right to buy the shares at agreed upon price. This agreed upon price is after 3 months, after some maturity period, correct? So agreed upon price is called as strike price or exercise price, the price at which you have a right to buy the shares. The call holder or the call buyer has right to buy the shares, correct? Who is B? B is the option seller who has obligation to sell the shares, correct? And the B charges some premium to insure A from risk of price rise. This much clear? Now come to next discussion. See here, this premium is a consideration for option. So there are two things here simultaneously going. See here, the consideration for option is the premium. The premium amount you are paying, suppose 5 rupees or 10 rupees is there, assume, okay? This premium is charged for entering into this option contract. So premium is paid for buying the option contract, buying the right to buy the shares. Are you understanding? This is the premium to obtain the right to buy the shares, which is option contract. There are two considerations here, children. What is that? Okay, options consideration to enter into this contract. Option buyer should pay the seller the premium, correct? The insurance contract, if you take, we will pay some monthly insurance, health insurance premium will be there. That is the consideration to enter into the contract. That is one thing. But in case if something bad happens, okay, what do? You produce claim, and insurance company will give you claim after verifying all the situations, correct? Now, there are two considerations here. In case of option contract, there are two considerations. One is the premium for entering into option contract. Second is that rupees is there na, the strike price or exercise price. This is consideration for buying shares after the maturity period when you actually buy the shares. Understand? There are two things happening simultaneously. First, on today itself, what do? Today you pay a premium. Sorry, my voice is a little bit, what do you say, hoarse or something, little bit different. But can you adjust for today? I don't know why it is like this today. Right? See here. You pay a premium. Premium is consideration for what? For option contract. Okay? And today you are entering into option contract by paying this premium. But there is one more consideration. 100 rupees that 100 rupees you will pay after 3 months. First you pay premium and get right to buy the shares. After 3 months, when you exercise your right, okay, at that time you have to pay one more 100 rupees. You cannot tell 10 rupees premium now. I have paid premium, give me the share. You cannot tell. Understand? So at that time you have to pay 100 rupees and you got the right to buy the shares. You will get the physical delivery of shares. Okay. Options also predominantly delivery happens through settlement, just like I explained to you in futures contract. Delivery, physical delivery rarely happens. In case of commodity options and all, it happens. But generally, options are also settled by way of net cash. Okay, right. This much you have understood. Clarity irukka? Or yes, Sulapa? Clarity is there? Have you understood?
Yes, it is.
Okay. Next. Okay, as and when we move on, we will get more clarity. One more thing I wanted to clarify. This option premium you have paid, okay, can you ask back the premium after some time, assuming you are not exercising your right? Assume after 3 months you are not buying. That's why it is called as option. It is not obligation. It is not compulsory. Understood? See here, A and B, both the parties are there. Understood? A has a right, but he may exercise, he may not exercise. In case share price today is 100, correct? Tomorrow the share price may fall to 50. At that time he will exercise. No. Okay, he will be better off rather than exercising this contract. Correct? He will allow it to lapse. In that case, he has right to buy, but no obligation to buy. Oh, the B party, the second party is there, the B. He has obligation to sell. Whenever A exercises his right, he has obligation to sell. Are you understanding? Okay, right. I will explain it further the coming slide. See here, types of prices for the share. Spot price. There are three prices available for the share. One is spot price of 75. Assume spot price is 75. I told you, Reliance spot price assume 2000. Like that, X Limited company ki currently equity segment you are seeing that spot price is what? Price quoted in the market today. What is spot price? Today, when you observe the market, current market price, you see the price is 75. Price of X Limited is 75. Then there is strike price. Just now I explained strike price, which is option exercising price, which is 100 rupees. At 100 rupees, you can exercise your right. Then there is third price, which is future spot price, FSP. What is FSP? Future spot price. See here, today spot price is 75. What is future spot price? On the date of maturity, okay, on the date of maturity, that is 3 months in our example. After 3 months, what is the spot price? At the date, at that date, you will have some spot price left. That is called as future spot price. On the date of maturity, what is the spot price? That is called as future spot price. So three different prices are there. See here, today share price is 75 in the exam. Strike price is 100. Future spot price, it may go up to 110. Situation number 1, the future spot price after 3 months, the equity segment share price is appreciated to 110. Share is quoted at underlying asset that is quoted in the equity segment for 110. And situation number 2, the share is quoted at 90. These are two situations. There is probability now. Okay, tomorrow after 3 months, you never know. You go to Swamiji and ask, okay, astrologer and ask what will happen to share price. Okay, he tells two options. It might go even to 100 110. It might even drop to 90. Two situations will be there. Correct? Now, what will happen in those two situations forms part of the further discussion. Have you all understood this? See, there are three types of prices. What are the three types of prices? One is today's price for the equity shares. What is the shares trading in the market today? X limited share price, if you observe the market, current market price is 75. Correct? And the price which is agreed upon, that is called as exercise price or strike price, which is 100. Okay, at that price you have right to buy the shares. Correct? And third price is called as future spot price, which means at the on the date of maturity, okay, there might be some spot price there. At that date, the shares might be trading at 110 or 90. That is called as future spot price. Two situations are given. Future spot price is 110 and situation number 2, future spot price is 90 rupees. Both the cases, what will happen? We will discuss. Okay, you have a right to exercise. Correct? This is right, not an obligation. Whether it is compulsory, this is where it is different from futures or forward contract. Option, in the name itself suggests that you have option. What is the option? A choice. What do you mean by option? You have a choice, which means either if the terms are favorable, you can exercise your right. If your terms are not favorable, you can just let it lapse. Understood? See, for example, assume there are two options given to you. Okay, either you can attend my classes physically, you can come to my address, okay, come to this coaching center and attend here physically my classes, or you have given the access for Zoom, okay, for lectures, okay, you can view it online itself. I have given you option. Understood? So today you feel that it is the weather condition is not very good, okay, or you are busy with your articleship or you are busy with your schedule, right? So you are traveling or you are busy with your schedule. Understood? So in that case, what you will do? If situation is favorable to you, if climate condition is fine, if everything is fine, okay, chalo, let me come to physical class. Understood? If condition is not favorable, I don't need to attend physical classes. Yeah, because I've given option. There is no compulsion. Okay. Same way here also, buyer of the option by paying the premium, what he is getting? He is enjoying the right. Correct? He is getting the right, which means there is no obligation put on his head. He may either okay exercise or he may either lapse. Seeing the conditions. Okay, he will see after 3 months what is the share price. Correct? And based on that, he will take decision whether to buy or sell this, whether to exercise my right or not. He will take decision appropriately. Have you understood? Now you see, assume what he will do in these two scenarios. Correct? Assume situation number 1. Situation FSP X or decision. Correct? X means strike price. So what you will do? Future spot price. You compare FSP. Okay. After 3 months, what is the price? You compare with exercise price. If the terms is favorable, you will exercise and make profit. Correct? If terms are not favorable, you will not exercise and you will allow the contract to lapse. For that, you already paid premium. That's why you paid premium. Yeah. See, situation number 1. What is happening? FS 110. Tomorrow, what is FSP na? FSP na future spot price, which means on the date of maturity, after 3 months, you are seeing that share price from today 75, yeah, from 75 it has jumped to 110. You see the share price is 110. Now whether you have obligation or option, right or obligation, you have right. In that case, future spot price is 110. Exercise price which you have entered into contract for how much? X is how much? Exercise price is denoted by X in your module and everywhere in the world. Okay, finance world, X is called as exercise price. Okay, so future spot price is 100. You have given right to buy at 100, same shares. Spot price 75 you did not buy, correct? You only bought the contract. Now, future spot price, a share worth 110, you have a right to buy at 100. Whether you will buy, yes, obviously. Correct? Inge paru, fair future spot price, which means today the share price, assuming after 3 months, okay, it is trading at 110, which means if you sell the shares in open market, you will realize 110 rupees. A share worth 110 in the market, you have a right to buy the share at discounted price, 100 rupees. Whether you will exercise or lapse, tell me children, you will exercise. Clear? You will exercise your right and buy the shares at 100. And what you will do, by paying 100 rupees cash, you will buy the shares and you will sell the shares in open market and you will make 10 rupee gain. Clear? Then what is the gain? Okay, the gain is FSP minus the strike price will become your gain in case you are buying, in case you are option buying. Okay, you are holding the right. Understood? Next situation. Situation number 2. FSP becomes 90. Okay, after 3 months, the share price dropped to 90, which means today it was 75. From 75, it has increased, but not to 110. Okay, only up to 90 rupees it has increased. In that case, what you will do? Okay, in that case, what you will do? Okay, you will exercise or lapse. You will lapse it. Why? Because you have strike price of 100 rupees. Yeah. I need to buy the shares in open market or I will exercise my share, right. Tell me whether you will exercise your right. No need, because you let the contract lapse and directly buy the shares in open market for even cheaper rate. Yeah, 90 rupees it is trading in the market after 3 months. Whether you will exercise your right, you will, that contract you will go and put it in dustbin, because market price itself is lower than your exercise price. You have bought it for 100, correct? But the share price is 90. Whether you will exercise? No. And if you exercise, it means that you are buying shares worth 90 for 100 rupees, which means you will incur loss. So no one in the world will exercise. Understood? So what will happen? Exercise price is 100 and future spot price is 90. Now you will lapse. You will let the contract lapse. Understood how exercise and lapse option happens in case of option buyer? This is clear. Next, come to put option. This is clear. Call option 100% clear. Are you understanding? So you might ask, see, one thing will be there. One question will remain. The second situation, when you are letting the contract to lapse, in that case, whether your premium will be returned back, you will ask, your premium, will the premium be returned back? No. Why? Because insurance pandrapa. Okay, you are taking health insurance. Okay, every year you are paying some 2,000, 3,000 rupees and your insured amount is to the extent of say 10 lakh rupees. Okay, you have some illness. If you have some illness to the extent of 10 lakhs, they will cover. The cover will be for 10 lakhs. Your premium will be very less. So they will write premium for 1 or 2% or something. So premium will be very less, 2,000 per month or 10,000 per year, whatever may be. Okay, the premium will be very less compared to the total insured covered value. Correct? In that case, so 10,000 rupees, can you go and tell, see, 2 years I have been insuring my health. Okay, I have got no illness till now. Please return back my premium. Can you go and ask her? He will beat you. Understood? So premium is sunk cost. It is already incurred. You enter into contract only after paying premium. Then only they will insure. Understood? If you don't pay premium for some amount of period, they will throw you out. Okay, they will not provide you any assistance in case of insurance. Same way here also, the premium which you pay, okay, it is paid only. It will not be refunded in any case. Understood? The same way, another question might be asked here. Okay, see, claim which you are making, will you think like, why are you paying premium in case I am not having any illness? Will you pray to God? Okay, see, I have paid premium 2 years, I am paying 10,000 rupees per year. Okay, every year, 2 years, I am paying 10,000 rupees. I am not getting any illness. My premium is getting wasted. Now, will you pray to God like that? No, no stupid person will do that, because the premium is to insure your risk. In case you are getting okay trouble, then in that case your expenses will be so high. Okay, so that's why the insurer comes into the picture and he charges you premium. Same way here also, option seller is there. He will charge you some small amount of premium and he will ensure you the risk of price rise. What is the risk in ECAP? Inge the risk is the person who wants to buy the share. Okay, for 100 rupees, he feels the share price might jump tomorrow and I might lose the opportunity to buy the share. That is the risk of price rise. Okay. Oh, so call option fully you have understood. Shall I move put option now? Have you understood? Or yes, Solomon? Shall we proceed?
Yes, sir.
Okay. Next, put option we will test. See, put option is very similar. Same thing. Only thing is, there A has got right to buy the shares. Here A is getting right to sell the shares. Okay. Two parties enter into contract wherein one party gets right to sell the shares at an agreed upon price. Okay. See, after 3 months at 100 rupees. Here also 100 rupees is strike price or exercise price and 3 months is called as maturity period. Only difference is A gets a right to sell the shares. Understood? So he gets right to sell the shares. You may ask him, why is entering into contract wherein he may sell the shares? A is bearish about the stock price. See, in earlier situation, A was bullish about the price. He feels 100 rupees will become 200. I will lose out. Okay, so I want to enter into a contract and enjoy today itself and okay, lock in a price. But here what is happening? This person A, the person who is entering into put option, he is fearful of the price getting reduced. He is thinking the 100 rupees price will, this company 100 rupees price will tomorrow become, after 3 months will become 50 rupees. In that case, he want to gain profit by reducing market. Okay, the market is going down. He want to enjoy benefit from reducing market. Bear market. Earlier, he thought, okay, that person was thinking the price will increase. Therefore, he entered into call option. He was bullish. I told you what is bullish and bearish. I explained in the future itself. Bullish means if a person assumes, if a person is positive about the share price increase. If a person is, okay, thinking that the share price might increase in future, he is bullish about the stock. Conversely, where the person is thinking that the share price might drop, okay, means he is bearish about the stock price. He is thinking that the share price will fall. In that case, how to enjoy, how to get benefit out of bull market? In case share price increases, you need to buy the share at lower price, sell the share at higher prices. Correct? In case if you think that the price, current market price is 75, if you think that 75 will become 100, what you will do? You will sell the shares at higher price, correct? Today and buy the share at lower price tomorrow. Then only you will make profit. That's the difference. Short selling. You will take sell position today and tomorrow you will buy and close your position. Understood? See. So what he is doing is entering into a contract wherein he will get a right to sell the shares. Right to sell the shares for agreed upon price, that is strike price. Okay. See here. Holder of the option. Here also A is called as holder of the put option. There A is called as holder of the call option. Here also A is called as holder of the put option. Very simple. Whoever enjoys the right, whoever has the right to buy the shares or right to sell the shares, whoever enjoys the right, that person is called as holder. Whether you hold the call option or whether you hold the put option, it depends on the nature. Okay, whether you want to take right to buy or right to sell, the call option and put option will differ. Okay, but both are holder of the option. Come to seller. B is seller of the option or writer of the option. Okay, writing is nothing but technical term. Insurance writing means writing na selling. Okay, insurance. Who writes the insurance contract? Who writes the option contracts? Who receives the premium? Okay, that person is called as writer of the option. Okay, C. So B is called as writer of the put option. What he has earlier, writer of the call option, okay, right? Buyer of the call option had right to buy the shares. If A has right to buy the shares, na call option seller was there, na he had obligation to sell the shares. Correct? Come to this put option. Put option, A has right to sell the shares, which means after 3 months, if he exercises the right, what B should do? He has obligation to buy the shares. Understood? Because A wants to sell the shares at whatever price, whatever price he is throwing, he is selling, you need to buy it. Understood? Okay, right. This is writer of option. And the pays premium. This is pays premium, put option premium. The premium pays A pays for to B premium, which is called as put option premium, for the consideration for the option. Right? This is clear. Types of prices for the share. Same here, spot price, strike price, and future spot price. 3 types of price. And future spot price, there are 2 situations. Situation number 1, the share price appreciates to 110. Situation number 2, the share price goes to 90. Current price is 75. 2 situations happen. Now we will see, in case of put option, how he will exercise or lapse, we will see. Okay, this is same as situation earlier call option. Now we will discuss how it is different. See, exercise or lapse. Situation, FSP, X, and decision. See, first situation, what is happening? Your future selling price, FSP, becomes 110, which is future selling price is the future spot price, which means the share price today is 75. Na? Our example, Reliance share price 2000 rupees. Na? If it became 2500, if it increases further. Okay, what is your X? Strike price. Strike price is 100, which means, read it, a share worth 110 today, you have a right to sell for 100. Whether you will exercise? No, because you will incur loss. The share is worth 110, yeah. Okay, if you hold the share, you will have 110 worth. If you can sell the share in open market for 110. Okay, and if you exercise, you will only get right to sell. If you sell, you have to sell for lower price, 100 rupees. Then it is not beneficial. Will you exercise? No. Why? Because the contract is not beneficial to you. You have a right to exercise. You will let it lapse. You will simply be quiet and let it lapse. Situation number 2, when the share price is 90, which has fallen below the strike price. In this case, what you will do? Your strike price is 100. Okay, future spot price is 90, which is currently trading, which means the share price is currently trading at 90 and the strike price is 100. Okay, which means what you will do? Okay, you have a right to sell for a higher price, share worth a lower amount, which means you will exercise the right and you will sell the shares. Clear? This much. Okay, which means this is the fundamental difference between a call option and put option. In call option, a holder of the option will pray to the god, okay, to pray to the god to for price to increase. In case of put option, you will pray, okay, you will believe that the price will fall and it will benefit you. Correct? In case of call option holder, benefit will be there when the prices increases above the strike price. In case of put option, okay, you will enjoy the benefit only in case the share price drops below the strike price. This is clear? Right. Now we will have integrated. Now you understood about call option, put option. Now I will try to confuse you and clear your confusion as well. See, rights and obligation. Yeah, you have to answer. There are 2 parties, holder and writer. Take call option. In case of call option, holder will have a right or obligation. Call option. Just remember, just think. Call option la holder will have right or obligation. He will have right. Correct? Right to buy. Correct? It is clear. Call option, because it is call option. Call option na buy da. Put option na sell. Understood? Call option na buy. Put option na sell. And if he is holder, he is enjoying the right to buy the shares. Understood? Then come to call option writing. What is happening? He has right or obligation? Obligation. Okay, when the
Obligation to sell.
holder has the right to buy, writer will have obligation to sell because other party is buying, correct? You are giving him right. So whatever price you are giving the right to buy, you have an obligation to sell at that price because you are like insurer, you are receiving premium, you are only producing the contract, correct? So he has obligation to sell. Understood? Then come to put option. Put option, what will holder have? Right or obligation? Two things.
Obligation to sell.
Put option holder. You will have right only. See, holder nale right da. Understood? Holder means right only. Option buyer nale, if you buy the option, you are buying the right. Understood? Okay. This is confusing. Don't worry. If you go home and revise one day, everything will be there. But this is the fundamental. Okay. If you know, if you are getting confused in this, question paper interchangeably they will ask. But you should be clear enough to identify what they are asking. Understood? Okay. When I verified the answer paper, majority of the students are committing mistakes here. Option vandale, they are fearful. Okay, because it is very confusing. Right? Obligation, selling, okay. Those things are there. FR paper, la kuda confuse pandrathu ketirukappa. In FR paper, there is a chapter called as, okay, financial instruments. That there is last segment called as derivative financial instrument. Okay. There we just need to compute profit and loss for derivative financial instrument. That is not an issue. But question, sometimes Mr. X sells Mr. X writes put option. Okay, writes call option, buys put option, buys call option. So everything they are interchangeably using. So you should be very clear in this. That's why I put a summary here in order to you to be very clear. See here, first let's again discuss. Come back. Holder, writer. There are two parties. Holder, writer. Correct? There are two types of instrument. One is call option and put option. Now first we are discussing about call option. Call option. Holder nale right. Correct? Above what call option will have? Right. Right to buy or sell? Right to buy. Why? Because it is a call option. Call option nale buy. Put option na sell. Holder na right. Writer na obligation. Are you understanding? See here. Call option right to buy. Writer will have opposite position. Obligation to sell. When A has right to buy, writer will have to obey the obey and contract should be honored. He should honor the contract. So he has obligation to sell. Come to put option. Put option, holder will have right to sell. Correct? Why? Because holder he will buy right only. And put option is about selling. So he has right to sell at agreed upon price. Writer of the put option will have obligation to buy because you have given the right to sell to the other party, which means at whatever price he is selling, you need to just take it. Clear that? Okay, obligation to buy. Next, come to comments of FSP versus exercise situation, call and put option. Okay, this is a technical term we will use in the market. In the money, out of money, and all. What is that? I am trying to explain. See here, if FSP is more than X, understood this matrix I am trying to explain. All the angles I am trying to explain and make you comfortable with the these two instruments. Okay, see here. If future spot price is more than X, understood? This is the situation. Okay, if suppose after 3 months, Reliance share price has become 2,500 from 2,000. Understood? In that case, if you are holding a call option, if call option, okay, if it is in the money or out of the money, will you buy call? Tell me, will you buy call or will you buy put? Tell me this. If future spot price is more than exercise price, buy the, okay, exercise. If you are a call buyer, what you will do? You will exercise. Whenever the option is, okay, is available to exercise, which is beneficial to exercise, it is called as in the money. It is called as in the money. Option is in the money. If you exercise, you will receive the money. Okay, you are in a beneficial position. This is called as in the money position. Understood? So come to put option. If future spot price is more than exercise price, then what will happen to put option? It is in the money or out of the money? Out of the money. By put option, you will let it to lapse. Okay, so which means it is out of the money. This is called as out of the money. See, when you have no benefit, okay, by exercising, now you will let it lapse. Case you are letting it lapse, in that situation, it is called as out of the money. In the money, beneficial pa. Udane you can exercise and you can receive benefit. That is called as in the money. Option is favorable. Option is favorable. In case it is not favorable, it is called as out of money. This is terminology used. Okay. Exam ke use in just terminology, they might use in some case study based scenarios. That is why I just explain. In the money, out of money. First MCQ they have launched in the BOS app. Okay, there was
Yes, sir.
there are three difficulty level, normal level, easy and difficulty level. Ange difficulty level question one of the question I saw option is out of the money, in the money, okay, indifferent. Option. That's why I'm telling you. While testing what the institute is doing, okay, study material, it will not be elaborately given. But they are capable enough to test all these concepts. Simply they will take questions from CFA. CFA ready-made course is available, and nowadays MCQs are there. They have the option to license to kill. Okay, if they want to set a high standard paper, they can copy from foreign sources. I told you. Okay, so it depends on you whether you need to prepare for a tough paper or you just okay, easily want to go and write. In case any surprise, there is no guarantee what will you get, how much marks you will get. There is no guarantee. Leave it. Okay, so that's why I'm trying to explain. In the money, out of. Okay, now understood. Wherever you are letting the option to lapse, it is called as out of. Whenever it is beneficial to exercise the contract, it is called as in the money. Understood? Next. Come to situation 2, wherein future spot price is less than exercise price. What you will do? All option, you will allow it to lapse. Why? Because the price is lower, future spot price is lower than exercise price. Call option will not be beneficial. Put option will be beneficial. Yes, put option will be beneficial. You will exercise put option. If you have put option, then you will exercise it. This is the second. Then future spot price is equal to strike price, which means on the date of maturity, you see that the spot price, the share price is exactly same as the strike price, which means what you will do, you will either exercise or let it lapse. You are indifferent. Okay, at the money, this is called as at the money. This is exactly trading on the same price. So it is not favorable or unfavorable, it is just same price. It is called as at the money. This is clear till now. See, last slide. After that, I will give you time to copy 5 or 10 minutes. You just copy. Thereafter, we will move to next discussion. See, classification, maturity. There are two types of options which we are going to discuss in the later stage of this chapter. For now, it is not relevant. Just I am throwing some light here. European option and American option. Two types of options are available in the market. We generally follow European option. Okay, in our market, Indian market, European option will be there. Ask the European option, why we Indian scenario, why we are discussing this, you don't think. Okay, just like two standards I told you in IFRS also, in the accounting standards, okay, generally accepted accounting principles gap is there. You will study in FR paper wherein there are two sets of financial reporting standards. Okay, wherein UK like European countries, okay, they have the IFRS, okay, international financial reporting standards. Okay, IFRS is followed by European countries, and American it is there an American gap. This is called as US gap. I've told you that this is called as US gap. Gap is generally accepted accounting principles. They will have number India is our India is there it is aligned to the IFRS, okay, European based standards, and it is not aligned to US gap. That I told you. Similar way, you have something called as double tax avoidance agreement. Okay, DTA provisions. You will study in direct tax subject. Okay, there also, if you see, there are some different clauses. Okay, anti-avoidance agreements are there. Okay, in that case, base erosion and profit, BEPS, they will give many clauses there. In that you have different agreements with different countries. We generally follow European standards only there also. Okay, because American generally if you take here also options, American options are not that beneficial. We feel that's why our market, Indian market also aligned towards European markets and options. Their financial instruments are available. European options are only available, which means, see, European option ko American option ko, what is the difference? I'll tell you. European option only on the date of maturity, which means if you are buying 1 month contract, if you are buying 2 months contract, or if you are buying 3 months contract, only on the date of maturity you can exercise or write, which means you can close off your position. Understood? Okay. And in case of American options, anytime before the maturity you can close off your position. This is called as, okay, close off your position, and you can exercise your position, your contract. You can exercise your lapse anytime before the maturity. This is American option. Understood? See, European options can be exercised only on the date of maturity. American options can be exercised anytime before the date of maturity, which means if you want to exercise after 10 days, if your terms are favorable, I told you, future spot price na sonna FSP. Okay, after 3 months na sonna, assume the Reliance price today is 2000. After 3 months, I believe it will become 2500. But to my surprise, it has become 2500 within 10 days. Then American option gives you that right to exercise it within the 10 days itself, that within the next to 10 or 20 days itself, anytime before the maturity, anytime. Okay, this is called as American option. What is the difference? How valuation differs between these options? We will see in the fag end of the chapter. Last session we will discuss. Don't worry about it. Just giving you intro. Okay, so sentiments of holder. See, what are the sentiments of holder? Option holder is there, na? Call option holder, what will the sentiment? Bullish. I told you. When will the person enter into call option? When he feels the price will increase. Price will increase, na? Bullish about the prices. Understood? Bullish, bearish, I explained you, na? Okay. If a person believes that the share price will increase in future, na, he is bullish about the share. If you see the economic times, if you see CNBC, channel, frequently some person will be telling, okay, we are bullish about the stock, we are bullish about the economy, which means we are thinking that it might go up, it will be favorable. That is called as bullish. Then the sentiment. Okay. See, tomorrow what will happen? No one will be able to predict. It's all speculation. Tomorrow it might go up, it might go on. Anything might happen. It's just a sentiment. Okay. When you come to call option, the holder has the sentiment. He is bullish. That's why he is coming to call option. He is coming to take the call option. Correct? If he is bearish, he will take put option. Understood? This is clear? Right. Sentiments of writer. Writer, what he will do? Okay. When he thinks the share price will go up, now what he will do? Okay. He will enter into call option or put option. Put option. If he thinks the share price will go down, other party ki it will be beneficial. So what he will do? He will take opposite position. Okay. So for a writer, okay, when he enters into writing the call option, he is bearish about the price. Understood? You might think, okay, call option has only upper hand. Okay, seller is not having any benefit. No. Okay, those person who are bearish about the stock, they will sell the option. Those person who are bullish about the stock, they will buy call option. Understood? Right. Put option, what he will do? Writer will be bullish. Understood? These two things. Okay. Sentiments of both option holder, writer. Option call, bullish, writer bearish. Put option holder will be bearish. Put option writer will be bullish. Understood? This is clear? Right. Can you note down? Take 5 minutes time and note this down. This writes down. Okay, quickly. Heading protocol. Call option, put option. You can quickly write heading. Call option. Have you understood this fully? No doubt, na? Because introduction is very important. If you revise, you will understand fully. At least give me this.
Yes,
Okay.
yes.
If you understood this discussion, your 50% of the entire intellectual discussion about option is over, I would say. Write down, by you don't need to presentation ka, I just put, you don't need to put the round this strike price exercise plan. A, B,
Yes.
okay, finish. Next, base premium consideration.
Yes.
See?
1 minute.
Okay. Bala ಪಡುವಣಪ್ಪ. Okay.
Yes.
Please revise this topic. Okay, introduction. Please revise tomorrow without revising. Discussion.
Yes.
Option. have given time to copy in between, but I don't want to derail the discussion. Okay, that's why I completed the entire introduction. Then you can.
Yes, sir. One minute. Yes, sir.
Understand?
Yes, sir. Ask him, sir.
Just to American option can be exercised in that's sentence are the listen.
Yes,
Okay. Set a mix of folder. Please revise thoroughly. That's why I've given all these things so that tomorrow onwards we don't need to discuss these things. That's confused. That's right.
Yes.
Sentiments of writer.
Yes.
Finish.
Yes.
Sentiments of.
Yes.
Finish. Now what we will do? We'll solve quickly question number 1, 2, and 3. Very simple, straightforward question, concept clarifying question. Then we will move on to other area. See here. Yes. Okay. You tell me. Okay. See here. Take question number 1 for discussion. Basics. From the following, find whether the holder of call option would exercise his right on the expiry date. See who is the person? Holder of call option. Understood? You have to always see 4 positions are there. Holder of call option, writer of call option, holder of put option, writer of put option. Correct? You need to visualize all this. Yes. Wait a minute. Can you see the note?
Yes, sir. Yes, sir.
Suddenly 2 or 3 voices came. Okay. From the following, find whether holder of call option would exercise his right on the expiry date. Okay. See here. So who is the person? Holder of what option? Call option. Okay. So strike price is 190. Actual futures price, which means actual future price na. Okay. Future spot price. Future spot price.
Yes.
After 3 months or on the date of maturity, what is the spot price they have given? Okay. 210 is there. So what you will do? You are a holder of call option. Will you exercise or not?
Exercise.
Exercise. Correct? Exercise. E in put exercise. L in put lapse. Okay. Exercise. Okay. Right. Strike price is 200. Futures price is 190. Actual share price is 190. Strike price is 200. Will you exercise as a holder of call option? No.
Lapse.
Lapse. Come to third one. Strike price is 370. Actual price is 400. Okay. 400 worth the shares is exercisable at the price of 370. Will you exercise? Yes. Correct? Understanding irkappa? Puriyadha? Very simple. If strike
Yes,
price
sir.
is less than, see, very simple. In case of call option, if strike price, okay, future spot price is less than strike price. In case of call option, okay, if future strike spot price is more than exercise price. These 2 scenarios will be there. Correct? In case you are a call holder, right? Okay. Now you see if you are a holder, call option holder. Then what is happening? Future spot price is less than exercise price. Will you exercise? You will lapse. Okay. If future spot price is more than exercise price, obviously you will exercise. Okay, clear? Now just compare here. Future spot price is more or less more. What you will do? Exercise. Correct? Future spot price is 460. Strike price is 460. Then it is indifferent. Indifferent. Okay, you can either exercise or lapse. It depends on you. Okay. Whether you exercise or loss. Question number 2. From the following, find whether the holder of the put option, okay, would exercise his right. I told you. Okay, holder will always have right. So on the expiry date, whether he would exercise his right or not. Serial number 1. Strike price is 270. Actual futures price is 240. We exercise put option ma. Strike price is 270. Actually, see, put option holder. Put option ke now there are 2 things. One is future spot price is more than exercise price. Future spot price is less than exercise price. The future spot price is more than exercise price. Na put option la you will not exercise because you want to price to reduce. Correct? Here you will exercise. Tell me, future spot price is more than strike price, less than spot price, strike price, less than strike price.
Less than.
Yes, you will
Exercise.
exercise. Surely you will exercise. tomorrow if the price is 300, up share worth 300 is available for 360. Okay, to sell, will you sell? Of course, yes. 450, 400. Will you exercise? Yes. Correct. Strike price, the more higher price you are selling, lower price you will buy. Correct. Then you will make 50 profit. Understood? Sell. Fourth case, what is happening? 190 is your strike
Yes.
price. 201 is your actual price, which means whether you will exercise, will lapse. Fourth case, what you will do? You will lapse. Correct? Because strike price is obviously less than the future spot price. No, not beneficial. So you will let it lapse. Third question. Okay. Third question. This around we will discuss and close our session today. Okay. This will take hardly five minutes or so. Option you choose from the following strike price and exercise expected future spot. Will you exercise the option if the actual futures spot are as follows? See here, what is happening? In this question, first you have to choose the option. Okay, which option you will choose? You choose the option. Okay, whether you will buy. Only I am talking about buying option, not selling option. Don't do it. Okay, so there is two options: call option, put option. So whether you will choose to buy call option or will take buy position in put option. Okay, first you need to decide. Thereafter, actual price based on it, future selling price. This is for actual future spot, not future spot price. Okay, you compare it to future spot price and make decision whether you will exercise or not. What I am trying to say in this question, how it is different is alright. First, strike price is giving, future price is giving. This is expected future price, correct? Which means whether you are bullish or bearish. If you expect the Reliance share price to go up to 2,500, you will obviously buy call option. You will take call option. But conversely, if expectation 2,500, but in reality, future spot price came to 2,000, 1,000, 1,800. You will not exercise your call option. So, this is what we are going to see. Question number 3. Can you see? Can you see the question?
Yes, sir.
What option would you choose on the following strike price and expected future spot? Will you exercise the option if the actual future spot are as follows? Understood that two column are given now. Choose the first. You have to choose the option based on our expectation. Understood? That's how you choose the option. Okay. While choosing the option, you will only predict. You will only you can be bullish or bearish. You will think whether the share price will appreciate or whether the share price will drop. Based on that, you will take a position. You will take by a option. In reality, the market price may be different of the share after 3 months or after the maturity period. That you compare with the current exercise price and decide whether you will exercise or not. Correct? Shall we proceed? Right. First, take serial number 1. Okay. Strike price is 100. Expected, you go to Swamiji. First day you go to Swamiji. Okay. Or a person, astrologer. Ask him to predict the future price. What he is telling? 120. Okay, your strike price is 100 rupees. Expected future price. What Swamiji told? Rupees 120. Which option you will choose as per the Swamiji's advice? Okay, 100 rupees will become 120. You will buy call option. Correct? What the option to be choose? Buy call option. Correct? Which option to be choose? Okay. This is it. So. Okay, come to what option you will choose? Call option. Correct? Now, Swamiji was right or not? Actual future spot. What is this actual future price? It became 120. Correct? He was right. Astrologer was right. 120 rupees it became now. Now, whether you will exercise or not? Tell me. Action to be taken. Exercise or lapse? Exercise. Call option you will exercise because it happened as expected. The price increased. You have got a right to buy it in lower price. Correct? Come to option number 2. Strike price is 180. Okay, when I go to Swamiji again tomorrow, he tells price will drop to 160. Okay, what option you will choose? Strike price is 180. Nah, expected future price is 160. Which option you will buy? Put option. Correct? Hey, you need to tell me. Okay, put option. Then only I will understand. Or you can put it in chat if you don't want to raise yourself. Okay, right. So you will buy put option. Is this clear? Okay.
Yes,
On
sir.
the date of maturity, what really happens? Okay, whatever he told happened now. 160 is the price. So what you will do? You will exercise and you will make a gain of 20 rupees per share. Correct? Exercise. Come to third scenario. Third day, what happened? Swamiji tells price will become 120. What is the exercise price? 100 rupees. So he tells he is bullish about the price. Correct? So what is happening? What option he will take? He will take call option. Okay. Then actual futures price on that date. What is happening? How it changed? It became 130. Swamiji was right or wrong? Yes, he is right, but கொஞ்சம் extra right ஆயிடுது. Okay, too much right. 130 it became. So
Laps.
no, laps எப்படிப்பா? Exercise. Still exercise na.
But okay, 100.
100 rupees is your strike price. He expected the share
130.
price to become 30 rupees, which means he expected a profit of 20. But in reality, after maturity date, on
30.
the maturity date, it became 130 and 30 rupees is his profit. So whether he would exercise, obviously yes, he would exercise. Fourth day, Swamiji tells, no, the share price will drop. Okay, you need to take what option? He is expecting put option. Okay, 135 is the strike price. Exercise future prices. They are expecting the price to drop to 120. That case, you will take put option. Now, what happened? Actual future spot price. Swamiji, wrong or right? Wrong. Gone. All the powers gone. Okay. Swamiji, Ambak Swamiji, waste. Okay. 137. The price has actually increased. So what you will do? You have taken put option. Whether it is of any use? No. What he will do? He will allow it to lapse. Correct? This you understood? See here, my strike price is 135. The actual price is above the strike price. Na? He has taken put option. Put option will only be beneficial when the price is lesser than the strike price. Here the price is more than the strike price. So he would the option would lapse. Understood? Come to last scenario. What happens? Strike price is 140. Okay, Swamiji is too bullish. 175. Okay. With due respect, he buys again. Takes what option? Takes what? Take position in what option? Call option or put option? Call option. Okay. Actual spot turned out to be what? 135 rupees. Understood? Gone, yes. Swamiji gone. Okay. 2 times prediction wrong. Heavy loss. Okay. 140. He expected the price to become 175. The price dropped to 135, which means below the exercise price. Wrongly taken call option. What you would do ideally? He would allow it to lapse. Okay. Swamiji also finished. Problem is also finished. Copy this solution. Yeah. No joke, yeah. What they have given now. It's an astrologer. அது ஸ்டாக்காலஜி அப்படின்னு சொல்லிட்டு எவ்ரி வீக் மணி கண்ட்ரோல்ல தே ஆர் ப்ரொடியூசிங் ஆர்டிக்கல். அது என்னன்னா தே ஆர் மிக்சிங் இட் அப் வித் அஸ்ட்ராலஜி அண்ட் ஸ்டாக் மார்க்கெட் டெக்னிக்கல் அனாலிசிஸ். அம்பக்கு பதிலா இதெல்லாம் போகி சுவாமிஜி. தி சுவாமிஜி ஆர் ஃப்ராடுலன்ட் சுவாமிஜிஸ். ஓகே. How you can predict share price? Even God cannot predict the share. Every day up and down, jumping up and down. How you can predict? Read this third question.
Yes, sir.
Finished it, Dattu?
Yes.
Sir, done, sir.
Okay, okay. With this, we are closing the session, today's session. Okay, see, one more thing I want to discuss. One more session, so, question number 4, yes, 5, 6, and 7, basic concepts only. And we will discuss a concept called as break-even FSP, break-even FSP. Yes. Then we have option strategy. See here, the question A, the learning objectives are given. Okay, you can verify after finishing this chapter. You can verify each and everything. We would have covered everything. Basics and option which we are covering. Then option strategies will be there. Then theoretical boundary, put call parity. Then option valuation model. Then see here, I told you na. At the end of the session, we will discuss about American options. Okay. All these things are European options. Independent European put call. All these are about European options. End of the session, we will discuss about American options. Right. Valuation here, only one thing I missed out. Okay. The premium alone is there, no? Okay. The fixation of the premium is there, na? Like for insurance company, they fix the premium. How much the premium to be charged? They have separate wing that is called as actuarial valuation. Have you seen this? This is a very emerging area. Actuarial studies. If you have noticed, for retirement plans, benefits and all, many finance company will have their own actuarial departments. அதுக்குன்னே ஒரு டிகிரிலாம் இருக்கும். Okay, people are pursuing actively those things. Actuarial valuation இருக்கு. Okay, they for example, if you are into insurance business, age இருக்கும், age factor, illness, with that they will predict something. அது கம்ப்யூட்டேஷன்ல கம்ப்யூட்டர்லாம் இருக்கு. Okay, when you see the ready-made calculator they have built, just like equity segmentல SAP calculatorலாம் இருக்குல்ல, அது மாதிரி they have built calculators. So actual science is okay, there is a separate study. So what I'm trying to say is like that they will do all these calculations and gratuity they will fix na. Like that you will fix the premium. The option seller will fix the premium. How to fix the premium will form part of the entire core chapter. அதாவது இந்த chapter's core discussion will be how to value an option. That is why you have see இங்க பாரு point number 6 the option valuation model, binomial model, risk neutral model, two period binomial model, Black-Scholes model, all are Nobel winning theories. Okay, economics Nobel Prize winning theories. In US they have given that because of these models. Okay, so all these we are going to discuss. Entire chapter revolves around how to fix the premium, how to value the option. It's all about ultimately how to fix the premium. The premium should be charged in such a way that option holder as well as option writer both in a equitable position, both in a fair position to start with. Otherwise, who will enter into a contract? Yeah, for example, if you have health insurance cover of 10 lakhs and if the insurer asks us for 5 lakh, yeah, I am better paying the hospital the amount, yeah, due to illness. Why I would insure? So ideally, I would not come to insurance itself. Understand? So all this we will discuss under valuation models. Very, very good discussion. We'll have in later session. Now I'm just laying foundation. Okay, right. I'm closing the session for today. Tomorrow, Friday morning, the same 6 to 8:30, we will continue this options. Okay, thank you.
Thank you, sir.
Thank you, sir.
Thank you.